This screen here, out on the table, I noticed when I came in today, there's a lot of IRS material, which are the handouts that I sent up for this presentation. So this resources is something that's got website information, publications, phone numbers, email addresses, so it's a good thing to hang on to. So make sure you grab one of those if you already haven't picked one up already. The next slide is, this is what our irs.gov website is looking like now these days. They just revamped it, so it's got a little bit different address than it used to. So I'm sort of showing you a screenshot of that and actually what the address is there for you. The second screenshot here is what Valerie talked about, those webinars and so forth that are online. This is the IRS videos portal that we have, and on that we have various webinars that have been produced that are specific to government entities and employers, employment tax related items. So please take advantage of that as long as you have computer access. We archive those. A lot of times they're actually you can actually be there live and sign up and get credit. A lot of people might want to have continuing ed credits if they have a professional designation or something, and they can actually view them live and get credit, but then we do archive them, and this is the site that they're at. First topics we're going to talk about, and like I said, we're going to try and get through as much as we can, as independent versus employee. So the next slide on here, we talk about what an employee is. And this is the actual Internal Revenue Code section that defines an employee. Basically, individuals under common law rules that perform services. We also have in the code statutory employees, which really are, I'm not going to get into those because they wouldn't totally affect you all. But the next one is the one that's sort of more unique to state and local governments, and that is any individual who's performing services that are included under agreement with Section 218 of the Social Security Act. And Section 218 is something that is an agreement between the government entity and Social Security Administration. And in the state of Indiana, and the next slide we talk about, what is a 218 agreement. They are very old. Most of them are back in the 50s, because prior to 1951, if you worked for a government entity and they didn't already have their own retirement plan, you were not covered for Social Security and Medicare. So to rectify that, the Social Security Act was modified, added Section 218 of the Act. That's where we get the terminology. And certain positions would be covered for Social Security coverage. In Indiana and every state, Social Security Administration has a certain person as the liaison or the interpreter of that individual state 218 agreements and all of the entities that have one. And that is Tom Parker. I was going to say Parker, but I want to make sure. And he's at NPERS. So if you have questions about your 218, if you want to know, do I even have a 218, that's who you would contact to get started on that. So Tom can help on that for you. So let's go on about common law standard. Basically, that the worker, if it's subject to the control of their duties, not only as to what will be done, but how it'll be done, is one of the factors that is a strong indicator of an employment relationship. And the next one, where it talks about the employer-employee, that will exist if they have the right to control the worker. You don't necessarily have to direct them and stand over them. It's merely if you have that right. Because many people, especially those that might have some professional expertise, you may not know how to tell them to do that job because you don't have that expertise, but you might have the right to make changes to what they do. So that's an overreaching factor. Some of the categories of evidence that we look at under common law, that's what we look at when we go out to do an exam on someone, if they treated them as an independent contractor, we look at these factors to find out, was that really truly what the relationship was? And there's three areas that we look at: behavioral, financial, and relationship. So on behavioral, these are some of the aspects that we look on behavioral. as far as, are there instructions provided? Is there training? Is there certain procedures that have to be followed in a certain step pattern? Are there assistants in there that are being hired to help? Who's deciding when to buy purchases of supplies and where? Financial then really affects the pocketbook, so to speak. Who's putting out the office space, the materials? Are there some unreimbursed expenses that this person is having to incur that they're actually coming down if they're going to make a profit or a loss on the whole venture? How often they're paid and the method of payment? Is that worker advertising these services to the general public at large? Are they advertising in the phone book? Are they known in what their services that are being provided? Are they known in the public arena at large to be hired out for this same service? Are they getting other business opportunities? And really, when we look at the financial aspect, in that whole relationship, does that person have the opportunity to direct whether they're going to make it a profit or a loss on the whole deal? The third item is on the relationship of parties, and sometimes benefits are provided. It just depends. Sometimes they're not. That's something we look at. Are they covered by the payer's insurance? Is this a continuous relationship, or is this a sort of like a one-time deal? They come in, they do the job, they're gone, you never see them again? Or are you continuing to use the same person year after year after year, and they're actually, what they're doing is probably an integral part of your operation? A lot of times what we see is there's a written contract, and in the written contract it says you're an independent contractor and you're responsible for your own taxes. But what we look at is really what is the true thing that's happening, and we look at the behavioral, the financial, and the relationship aspects of that to make a decision under common law as to whether that truly is an independent relationship or an employee. So some of the aspects with the independent contractor I've listed here, these are not all-inclusive, but they're things to think about. Again, they're making their own schedule, they're buying their own products or materials for the job, they have their own equipment, they're making the decision whether they're going to make money on this venture or not. Whereas employees, most of those type of things are being provided by somebody else. They just show up, do the work, and go home. There's no economic reality of them being poorer in an economic sense, totally out of their pocket, that they're going to lose money on this. Again, they could quit the job without any risk of being sued or something like that. We're an independent. Usually, they have to stay out and finish the job until they're done. So, now next on this is we talk about, well, who are government employees, and we need to wake up, honey. Go ahead. Okay, government employees. Now next, see, I told you no. The next slide I've got two handouts just pictured on here. We have two handouts pictured on here, Valerie. There we go. She's rusty. I'll give it to her. These are some items that, and to be honest with you, my eyes are failing me anymore, but we've got several handouts out there about who is an independent versus an employee, who are really elected and appointed officials. I think there's one on that. Those are some handouts that I wanted to provide to you. Also, I think there's one out there on election workers, but you might have that further down in our presentation. The next slide is just a small wheel chart on there that gives ideas of what all could be included in a W-2. And really the next slide then we get into governmental employees, which we've got elected and appointed officials, volunteer firefighters, election workers, and all groups that are considered as an employee under that entity's 218 agreement. So the next slide we talk about elected and appointed officials. Now elected officials are always, always, always going to be an employee for federal income tax withholding purposes. That's in the code. You cannot get around it. It is in the code. As far as the FICA goes, again, that sort of complements back over to what I talked about, the 218 agreement. If your 218 agreement has already deemed that position, that elected position, as an employee, it's an employee, so they need to be having FICA withheld as well. And most of the time, as I've listed on here, the reason that you're going to have these people as employees is because that position is established in statute. Their duties are defined by statute. They're responsible to the public. They're performing these services as a public official, and they're being paid out of governmental funds. In other words, the public is not directly coming and taking from their pocketbook and directly into that official's hand as a direct transfer. It's going through a conduit of going through the governmental checkbook and then back out again. A lot of people will call me many times on this subject about elected and appointed officials. And basically what I've been trying to tell people is, and this probably isn't really nice, I'll probably get in trouble saying this, but oh well, I've known Valerie a long time, it doesn't matter. If you could open the phone book and find in the yellow pages public officials, please let me know. Because I've yet to open up my yellow pages every year and ever find the category public officials and that I could hire one privately. So when you stop and think about it, that's what in your mindset you need to think about, especially if there's others that are saying, well, you put them out on a 1099. I mean, you know, that is an independent contractor. You open up the yellow pages and they're there. They're a plumber. They have their own crew. They have their own trucks. I mean, just think about it. If you can open up the yellow pages and find public official in the yellow pages, then please send me your telephone book because I'll be interested in that one. So, next category we talk about is the volunteer firefighters, and I don't really know how many of you all here in the room deal with that. I deal with that a lot of times in the smaller agencies. But again, volunteer firefighters are going to be considered employees under the common law rules. We look at them. The common law rules are applied to everyone. So whether the term on their label is volunteer or not, we have to look at the same thing, what we talked about on the behavioral, the financial, and relationship. So if they meet the common law rules, then all the employment taxes will apply. And depending on however they pay them or however they call their pay, whether it's a stipend or a run pay or a meeting pay or training or whatever, you know, if they're meeting common law rules as an employee, that pay is wages. So it doesn't matter how you want to label it. Sometimes they are given allowances or reimbursements if they have protective clothing, safety shoes and boots and the like. As long as they turn in receipts and substantiate that expense, then that allowance or reimbursement that they are given is not taxable to them. If they don't, then it follows the rule of accountable plan that if you're not accounting for that, it's considered a wage, and so it's just an additional wage payment. In other words, you give them $300 a year and they walk out the door, you never know what they did with it. That's under the law, that's considered a wage. So, and also on the mileage, if they're commuting back and forth to the fire station and getting reimbursed for that, that's personal commuting. That would be a wage as well. So, again, I'm not sure how many of you all have that touch your lives in your counties there, but wanted to mention those. The next big one is probably why I haven't seen you for probably about 6 years. The last time I talked about election workers, and I don't know how many of you were here, but the room fell apart, let me tell you. I was afraid to come back. I thought I was out here by the skin of my teeth. So, at any rate, actually, that really what happened with that whole thing is the state's 218 agreement got modified and updated and changed. So in a way, it was a good thing because we were dealing with rules back then as far as the wages that an election worker was paid that was based on something that got changed back in 1979. And by that time, I want to say that might have been like 25 years, almost 25 years had passed. So on election workers, they're always, sort of like I said, always with the elected officials for income tax withholding, they're actually the flip of that. They're always exempt from income tax withholding on that election wage money, okay? And the wages, and I'm going to have a little caveat here at the very bottom. You see a revenue ruling 2000-6 for reference. If you've got someone who works for the county and decides they're going to work the election, if they're already a county employee, some of this is going to be a little different than just someone who you straight out have that's maybe retired and comes in and works the polls. Generally, if they're just coming in, they're retired, work the polls, they don't work for the county in any other capacity at all, they just come in and do that only. As long as those wages are less than $1,500, which that number gets changed with inflation year after year, those wages would be exempt from Social Security taxes as well. So if you got someone that only makes, let's say, $200 the whole year working the election, and that's all they do for the county, they come in, do the election, they don't work for the county in any other capacity, then you're not going to have to worry about filing a W-2 or having to withhold on anything. It does not mean, however, that that's tax-free money, which seems to be a problem. It's still income to that individual, and they are to report it on their return. There's actually a line on the bottom of the Form 1040 that's sort of a other income or other income line that they would actually record that and report that. If the amount that they make is $600 or more in a calendar year, then a W-2 would be required that you would have to file on them. And then this Revenue Ruling 2000-6, that actually addresses people who both work for the county and do the election polling work and how you have to handle them. And I know in the past I have forwarded that revenue ruling and an explanation to Tammy and to Deborah before. I'm not sure if I provided that in your handouts this year, but if we need that, I can always forward that again and they can send that out for you all. Next category we talk about, I thought I would jump into, is funding. That's another question I get a lot is, well, the funding for this position came through a grant. Well, generally grants are not going to be taxable, so I think a lot of people have the idea, well, if it's not taxable, then that's not my employee and I need to put it out on a 1099. We don't care where you get the money. The bottom line is if they meet those common law tests as an employee, then they're an employee. So that's where you really need to focus your efforts on figuring out how you're going to treat this person, not necessarily where the money came to pay them. So there's a couple publications that I think I referenced later. I've mentioned it here. This SS8 is a form that you can turn in to IRS, and it actually is really the common law factors all out in a question format. There are 2 service centers in the IRS that handles these SS8 forms, and what they do is analyze what it is that you indicate on the relationship, and these actually can be filled out either by the employer or would-be employer or even the worker, so that they know based on, okay, here's what's happening in this relationship, can get a determination as to whether that is truly an independent contractor or an employee. Next thing I would just want to mention, back to governmental employees, if you were hired after April 1st of '86 and you weren't under a 218 agreement or by mandatory law, which that's a whole different category, which I'm not going to get into that because we just don't have the time, but basically there's certain ones that, you know, mandatorily law that they'd have to be covered. If you were hired after that date, then you definitely are subject to Medicare. Most people that might apply to might be your police and firefighters. If you ever notice on W-2s, they're only having Medicare withheld out. That's probably those categories of folks in payroll. Then the laws got changed a little bit later on in '91 that anyone after July 1st of '91 who were not already in a 218 agreement and they weren't in what the IRS deems a qualified retirement program, they have to be covered for Social Security and Medicare tax mandatorily by law. So that's something that you have to make sure you're withholding the proper amount of taxes. This is a slide that I'm talking about with the SS8 and the publication 1779 that talks about the independent contractor control factors that we've already went through, and also the SS8, where it can be filed. So really the bottom line on independent contractors is you have to evaluate your circumstances and measure it against the common law rules, because that's what we do, and that's what the SS8 unit will do. And it really doesn't make any difference how you want to term the relationship, how you want to call it, if you want to put it down on paper and say, well, this is what you are. That really doesn't matter. What matters is, are they truly an employee under common law rules? And so really the substance of what's going on in that relationship is what's going to make a determination as to what that person is to you, whether they're an independent or an employee. Now, since a lot of people sometimes come away from these things and think, oh my God, we've got problems in River City, we do have what we've instituted, the Voluntary Classification Settlement Program. This is something that we've had out, I think, a couple years now, that if you're not already under audit or something like that, and your 218 agreement doesn't even have this position covered, and maybe you've been handling them in the wrong manner based on what you've heard today, you can voluntarily come to IRS and get yourself straightened out on that. There's lower rates that apply, and it gets you, up in and running in the right way with that certain worker. And there is more information on our website about that. Okay, so now we're going to talk that we've got employees, we've got wages, and these are the various kinds of different things that we have. There's cash wages, and then there's your non-cash wages, such as your fringe benefits and the fair market value of items such as autos and so forth. And I'm going to sort of talk a little bit here briefly about the employee business expenses. If you have reimbursed employee expenses that are accounted for, then those are not going to be taxable as wages to that employee. But if you have those that are not accounted for under what we'll get into here in a second, accountable plan rules, then those are taxable to the employee, and that's actually called a non-accountable plan. So let's go next to our slide here with accountable plan, and really what that means is it's an allowance or some type of a reimbursement where certain amounts are non-taxable if certain things are met. And there's 3 rules for that. There has to be a business connection for the expense, there has to be adequate accounting, and there has to be any excess monies returned on a timely basis. And if it doesn't meet any of those 3, then it's actually considered a non-accountable plan, and those reimbursements or that allowance that you might give someone is actually taxable as wages. So the first aspect of that rule is business connection. What really has to be, again, directly related to the trade or business, which basically would be their job that they're doing there for the county. And it would also be something that would be deductible on the Form 1040. Good example, when you think, well, what do you mean deductible on 1040? Let's say someone's driving the county car somewhere in a different county coming back, and they're speeding and they get a ticket, okay? That's a fine, that's a penalty, that is not deductible under the Internal Revenue Code, which my husband was quite upset one year when he was coming home and he was speeding and he got a ticket and his employer wouldn't pay it. Can we deduct this? No. So that's the kind of thing we're talking about if it's deductible on a 1040, okay? Adequate accounting is where you're verifying these aspects of that expense, the time, the place, the amount, and what the business purpose was for it. And then the third is if there's an advance of monies and there's excess monies left over, there's a return within a reasonable time. There's 2 methods there, the periodic method and the fixed date method, which I wasn't going to get into any of that. Actually, the publication 15B gets into some of that. So most of our materials that you can download or have on the website, actually even our taxable fringe benefit guide that we have on our website has a host of this information. So that's why I didn't want to get into big details, since we're trying to get as much as we can covered here today. So we're talking a little bit here about fringe benefits. So these are going to be some of your non-cash items that could be considered wages. Give you a definition and the taxability of those. Basically, it's a form of pay for the performance of services, and it could be in either property or services or even a cash or a cash equivalent. So the main rule is all fringes are taxable unless there's a section in the Internal Revenue Code that exempts them from taxation. So the process on that generally is to identify what benefit it is, determine if it's excludable, and if it's fully taxable or only partially taxable. And again, I've referenced for you here publication 15B that is our fringe benefit guide. If it is a taxable fringe benefit, then it would be included in the employee's wages. It's never going to go on a 1099 miscellaneous. It's going to go on the W-2. It's going to be subject to your employment taxes of FICA and income tax withholding. And that taxability of that fringe benefit may even be extended if it isn't the employee directly getting the benefit, but a relative, maybe a spouse or a child of the employee. The next slide talks about some exclusions under the code. There's certain ones. Medical premiums are a taxable or a non-taxable fringe, rather. In other words, what your employer pays for your share of medical insurance is not taxable to you. Qualified reduction, tuition reduction, meals and lodging, and so forth. I won't, bore you with reading there. There's some additional ones that are under what Section 132 in the code is actually the fringe benefits, what we sort of want to call working condition fringes. And I've actually got some handouts, I think, also available that I sent out to you on the no additional cost and the employee discounts. But these are some certain benefits here that might be non-taxable to the employee. Next slide talks about the working condition fringe, which basically, in order for that to be considered non-taxable, that it has to relate, again, to the employer's business. They would have been entitled to deduct it on the 1040, and there has to be substantiation of records. The biggest one that is the employee's use of the employer's car for business reasons. So that's really where that's considered a working condition fringe. You're not going to tax them on those miles they drive for the employer that was business related for the employer. These are one of the handouts on the no additional cost service and employee discount. I think I have a second slide there that then also is probably the employee discount one. Just wanted to mention those are out there for you as well. The next slide sort of goes over no additional cost. It has to be a service that's offered by the employer in their ordinary course of business to customers. The employee that receives the benefit performs substantial services in providing that service, and there's no additional cost to give it to the employee or any lost revenue in providing it to the employee. And that handout I gave you is a really, really good article on it. It's actually from one of our previous newsletters, as Valerie mentioned earlier, that we had put out several years ago on that question. The next slide is on the qualified employee discounts. Again, the property or the service has to be offered to the public in their ordinary course of business, and the discount cannot exceed, if it's merchandise, this gross profit percentage, or if it's services, more than 20% of the price. Again, publication 15B explains that, as well as that those handouts. So I wasn't going to go all through those mechanics of those. The next one is probably the one that caused everybody grief, including me. The cell phones. Well, those sort of got fixed. Congress made some changes in the law a couple of years ago, and it really, I think, muddied the waters more than helped. And so in order to rectify that, IRS came out with some notices back in 2011, which basically talks about the cell phones. And so these are the rules now on cell phones. Basically, it has to be provided, if you're giving that phone to the worker, it's your phone, the government's phone, and you're issuing it out to the worker, it has to be provided primarily for non-compensation business reasons. There's a reason that this person has to have the phone. They have to be contacted after hours, those kinds of things. Personal use then on that phone is considered de minimis fringe. It would not be taxable to them. And if the reverse is that it's the employee's phone and you're giving them an allowance, basically, as long as it meets those two rules or the rules that it's a non-compensation reason, that there's a reason that they need to be contacted after hours, then if you're giving them a stipend or an allowance amount every month, then that's not going to be taxable to them. The website does have information on it. It has the notice that I reference here, as well as the memorandum that was issued to the examiners, to myself, on the treatment of when it's the employee's phone and the government entity is paying the employee some money towards the cost of that phone. Okay. The next thing is meal allowances and reimbursements, and we've got two categories. The next slide talks about if they're traveling and when they're not traveling. And there's meals with meetings or entertainment, and there's also de minimis meals when you're not traveling. So this is always a favorite subject. Cell phones was a heartache. I think meals are a heartache too sometimes, although I'm really hungry and I haven't had my meal, so if you hear anything in the microphone, you'll know what's going on. Meals while traveling, okay. It's going to be tax-free if it meets these requirements, which really you have to be away from your tax home overnight or long enough that you have to have substantial sleep or rest. There's no set distance or no set amount of hours. I mean, that's the criteria. You have to have the employee substantiate the expense, and you actually could either use the actual receipt method or a per diem method. The substantial sleep or rest rule came out of a Supreme Court ruling, so that's the highest court in the land, so we sort of have to follow what the Supreme Court told us on that. It's actually, I think some of it came back from a really old case with a railroader, I think is what it ended up, where that substantial sleep or rest came in. And this guy was a conductor on a railroad, and he would, take his route, and during the course of his shift, he actually had enough time in between the time he had to go back and make the return trip back. He actually rented a hotel room, and he physically needed that refreshment of a rest. And then that's where the courts determined that's substantial sleep or rest. It's not pulling over in the side of the road and taking a cat nap for 45 minutes. That's not considered substantial sleep or rest. So that's where that came from. Meals not away from home would include meals with meetings or meals with entertainment or de minimis meals. So when we talk about meals with meetings or entertainment, these are the tax-free rules on those. They have to either meet the directly related test or the associated with test. Now, directly related means meals as part of a business meeting, much like what you did today. Your meal was in part of this whole thing you're reading together. Or if you're at a service club as a representative or something, that's something else we mentioned here. The associated test, again, the meal has to be in a clear business purpose. There has to be a clear business purpose for the meal. There are substantial business discussions or negotiations that either precede directly before the meal or right after. So associated with meals or meals at conventions, meals at conferences, and I just now misspoke. That's what we had here was associated with. I seen you all out there eating, and Valerie went and stole animal crackers from somebody, so. Meals and allowances and reimbursements, the substantiation methods that are used. If you're not away from home, if they are per diem and they're not meeting those, the per diem method is going to be taxable. If you're using the actual receipt method, as long as they're meeting the either directly related or associated with test, those would not be taxable. De minimis meals, again, the rules for those that are going to be, they're going to be tax-free if it's small and occasional, if it's provided in order to let that employee work overtime and the employee does in fact work overtime. It's not based on the amount of hours worked or anything like that. It's the whole reason you're giving it for them is because they're having to work overtime, and they do work overtime. Next slide we have is meals that, or what I mentioned here is if en route to a meeting or what have you. If it's a daily event, then those are going to reimbursement for those. We're not saying you can't reimburse them, but if you do, they can be a taxable event to the employee. So if you're coming up and you're going home tonight and sleeping in your own bed, you're getting reimbursed for a meal, that's actually a taxable fringe. If you're up here, spend the night in this hotel and get reimbursed for it, that's an overnight stay, that's not going to be a taxable meal to you. So basically, that's why I put in here, no hotel means a taxability situation here, unless you've got the associated or directly related test involved in there. Okay. Next area, and I know I'm going quickly, but I'm trying to cover as much as I can for you, is vehicles. Is my man flashing on there? I don't know. Okay. See, I have bling too. Yeah. Okay. Personal use of an employer-provided vehicle is going to be taxable to the employee. So if they're issued a vehicle and they commute back and forth to work in it, and you're probably thinking, but there's people that do that. Wait a minute, we'll get to that slide just a second. If it's commuting back and forth, that's actually a personal expense, and it's a taxable fringe to that worker. Sometimes you might have, I'm not seeing this too often, vacation or weekend use, but I suppose it can happen. How you value that personal use, that employee has to keep a record of that vehicle's mileage for both business and personal. If they don't keep records, what the code says, every bit of that mileage on that vehicle is personal use and taxable to them. It would be very beneficial that the employee keep some kind of a record on business and personal miles. To value that personal use, there's 3 different methods that may be employed. There's the lease value, the cent per mile rule, and the commuting rule. And the taxable fringe benefit guide and the publication 15B gets into the nuts and bolts of those for you. Then we do have the employer-provided vehicles that I mentioned a second ago that are what we call qualified non-personal use. And what the code says and regulations say about that kind of a vehicle is that by the nature of their design, they are not made to be considered a personal vehicle or conveyance for the employee. Using those then would be tax-free, and they would not have to keep records. The most ones that you think about would be like your sheriff's cars, your police cars, and the like. So those have to be clearly marked, and also public safety officers. That got added into the code a couple of years ago. And then I've also listed, this is just a snippet of what's actually in the regulations. There's probably about 20 or 25 categories that would be considered a qualified non-personal use vehicle, but I've sort of listed the ones that are probably the more prominent ones that you might be more closely related to. So on the clearly marked police and fire, they always have to be on call. The employer is requiring that employee to commute in that vehicle, and they're also prohibiting any other personal use other than that commute outside of the employee's jurisdiction. Now, there are 2 other types of vehicles that a lot of government entities are going to have, which is going to maybe touch you all, and that would be the pickups and vans. This is a revenue ruling back in 1986, and it basically tells you that if there are certain vehicles that their gross vehicle weight is under 14,000 pounds, and if there's certain modifications made to that vehicle, then the commuting of that vehicle, if the employee drives it home and back and forth to work, is not going to be taxable to him either. So they fall into, normally that'd be something that would be taxable if they were driving it back and forth, but if these modifications are made to it, then it's not going to be considered taxable to him driving it back and forth. The pickup trucks and vans have to have certain modifications on them. Some of the things they have to have, first they have to be clearly and permanently marked as to, it's an official town vehicle or county vehicle. And they may have either like a hydraulic lift gate or tanks or drums or something permanently installed in the bed of a pickup truck. And for a van, it might have to be modified that it only has the driver's seat and perhaps just a jump seat in it. and the back of the van has racks and shelvings and those kind of things to where you really can't, pack your kids in it and go down to Holiday World. So I used to put pictures in my PowerPoint, but I was trying to get as much in here for everyone, so I didn't put my pictures in. But there was always a picture that would show a pickup truck with just a diamond plate truck bed, or what was that, truck box in the back, and it had a seal on the side. The fact that it had the truck box, people would think, well, that's going to qualify because that's a working truck. But it would not qualify because it didn't have those modifications under that revenue ruling. The tailgate was the same tailgate that it was when it was manufactured. Now, if they would have took it and put a hydraulic tailgate on it, that would have been a different story. The van had shelving in the back that when you opened up the back of the van and looked into it, it had racks and shelvings on it, so that showed you what it meant. So didn't bring those with me on this slide this time, but that gives you the general idea. Okay, as far as employees' vehicle, them using their vehicle in the employer's trader business, if you reimburse them mileage for business miles at or below the federal rate, then that reimbursement is not going to be taxable to them. Again, assuming they're turning in a travel report to indicate where and when and the mileage that they were incurring for the employer. Next is uniforms and clothing allowances. That's another subject I get questions on. There's two requirements that make this non-taxable, and they have to be, first of all, required to be worn as a condition of employment. In other words, if you show up to work in something else, you'd get wrote up for it. I mean, they expect you to wear this attire, and it can't be adaptable for everyday use. And that counts even if they leave it on site and go home. I know this seems sort of a pain. All I can comment on is this is hinging on a revenue ruling that is as old as 1970, I think. And unfortunately, times have changed since 1970, but we haven't had anything updated in our official guidance and actually revenue or rulings or law that would make that change. So we're still hanging on to these rules, and that's what we sort of have to go by. If that clothing reimbursement or clothing allowance meets those rules and you also pay for the cleaning of it, then it wouldn't be taxable for paying for the cleaning of it either. I mentioned here some different things on uniforms that would not count as a non-taxable event. So just plain clothes and shirts, sport coats and things like that for maybe detectives, those kind of things wouldn't. And again, I mentioned if the uniform's non-taxable, then the cleaning is too. So that sort of covers the fringe benefits. I'm really at a breaking point unless you want me to go on. Do we have a few more minutes or? Okay. Okay. All right. We'll try and skim through this real quick if we can. I know I've just loaded you up with a lot of information, but next thing is when you're dealing with vendor payments, these are some of the required forms you need to be aware of. The W-9, the 1099, the Form 945 might come and touch your life at some point. So what's a W-9? I don't know how many may or may not be aware of that, but it's required for anything that's reportable on a 1099 if it hits $600 or more. It helps you, first of all, make out that 1099 at the end of the year. It protects you from backup withholding tax, which we'll talk briefly about. And it's also certifying to you as the payer that vendor is not subject to backup withholding taxes. What I want to mention here on this slide, the LLCs, those are something that you need to make sure on the W-9 you get the right category, because for federal income tax reasons, they could be taxed either as a corporation or a partnership or a individual. So it's really important that when they fill out that W-9 that you know exactly how they're being handled from a federal income tax standpoint. Make sure the W-9s that you use you're using the most recent version if you're looking to get a new vendor. The form that's, I think it's December 2011, has sort of modified that LLC line on that form so that the vendor can fill out and let you know how they're actually being taxed on federal purposes. If you don't get the W-9 and you don't have their tax ID number, then you're looking to immediately back up, withhold 28% of whatever you pay that vendor if the type of things that you're paying them are what we call reportable payments. So best advice, get that W-9 information up front. Your 1099s, payments of $600 or more for rents, for services for people who are not your employees after you went through the common law test. And also, combination of any services and products that are paid. Let's say you have a town vehicle and take it to the local garage and you spend $1,500. That is what we're talking about. That $1,500 could very well be parts and labor, you know, in that figure. So when we talk about combination of services and products, that's what I'm meaning by that. Payments that shouldn't be on the 1099, of course, would be anything that should be showing up on a W-2 for an employee, such as your fringe benefits or travel reimbursements that might be taxable. And normally and generally, payments to a corporation are not going to be on a 1099, but there's a couple exceptions to that rule, and that is if they're providing legal services of any style or medical health services. This slide here is another handout that I had for you out on the table. It's sort of a checklist of who gets a 1099, what kind of payments show up on a 1099. So it's a really good handy reference in an all-encompassing one page for you. Payments to attorneys, again, there's your legal services. The law got changed back in 98. Basically, it doesn't matter how the attorney fashions his practice, whether he's a partnership, a corporation, an LLC, a sole proprietor. If you're paying $600 or more to that attorney, he needs a 1099. Now, he'll probably argue with you, but he needs a 1099. And also settlement payments that are in the attorney and the claimant's name, if they're a taxable event, are going to have to be put out on a 1099. Here's your exemptions. Again, if you're buying just merchandise only, purchases at Staples, Walmart, Office Max, those kinds of things are not a reportable item on a 1099. Payment of rent to real estate agent, someone who's acting on behalf of the owner, you wouldn't put out on a 1099. And again, the corporations, unless they're medical or legal. When you file the 1099, they're calendar year based. January 31st needs to be given to the vendor, to IRS if it's on paper by the 28th of February. If you electronically file, you have till generally March 31st. Should keep records of these, and if you need to extend some time to get the copy into the IRS, you do that on the Form 8809. Of course, there's penalties in life for everything, death and taxes. That's what I was told my whole life growing up. Failure to furnish a form to the recipient, it's a staggered rate. I've given you the different penalty amounts there, and then if you fail to file the copy with the IRS, it's $100 per 1099, so it can be expensive. Errors that we find a lot of times, you've never gotten the W-9, so now you're looking at backup withholding problems later down the road. Failure to aggregate all your payments together from all of your vendor files, or just assuming someone's a corporation because of how their name is titled maybe on that invoice, or maybe because they gave you a federal ID number. Form 945 is used to file your backup withholding tax money. It's an annual return to IRS. As far as if you have to get into backup withholding taxes, you deposit those on the same deposit schedule that you would your Form 941. You send those in and identify those separately to IRS, though, so that that money doesn't get commingled. Backup withholding itself to the vendor is shown in box 4 on the 1099, where it says FIT, or federal income tax withheld. You still show the gross amount that was due that person, and then the amount that you withheld is shown on box 4, so that when they file their tax returns, they'll get credit for that money that was withheld. Okay, I'm not really going to have time too much for CP 2100 notices, but if you get your W-9 and certify and make sure it's been checked thoroughly and it's the right name and number combination, hopefully you won't get a CP 2100. But what happens is 1099s come in about, they're due to us and by February, and usually by the following October, by about this time, if the name and number didn't match the IRS systems, then you get a letter saying your name, these 1099s have a mismatch. That's what this notice is. And there's different steps that you have to take to make sure that you have the right name and number. If they show up year after year, there's different steps that you take as far as those what we call B notices. And the publication 1281 is a great resource guide. I almost call it my Bible for backup withholding because it's very user-friendly, and I'd encourage you to take that over. The other thing I want to just briefly mention at the very back is what Valerie's got on here is the online 10 matching program. We just did a webinar that actually I was involved on that's should be showing up on that IRS video webpage that you can get into to check those W-9s right when you get them, and if it comes back and gives you an answer saying this isn't a match in our records, then you can go right back out to the vendor and say this is not matching IRS, records, and we need you to complete a correct one. So I'm sorry I had to rush all through that. I had so much stuff. Oh, and Valerie wants you to make sure you sign up on those yellow sheets if you want to be in on the phone forum so that we can send email blasts out to everyone. Appreciate your attention and hope you have a good afternoon.